Hello, this is Greg Giardino and Alison Hall with It's Your Smarter Money. And today we're going to review with you some year-end tax planning strategies that you should be taking advantage of. So let's talk a little bit more about that. All right, so if you haven't maxed out your tax-deferred savings in 2024, make sure you do so. So either call up HR and submit what's called a salary reduction agreement form, which basically tells HR how much to deduct to max out, or go online and make sure you adjust and put in for your last paycheck. So as you can see in 2024, you can put, if you're under the age of 50, $23,000 away into pre-tax deferred savings. And you can see in 2025, that number will be increasing to 23,500. Now, something to take note on this slide here, it's really special. It's new for starting in 2025, that for those who contribute 23,000, they normally can contribute what's called a additional catch-up contribution of $7,500 on top of 23,000 in 2024. In 2025, I put a big bright yellow star next to it. It's that important. That number is now going to go up to 11,250. So make sure you're aware of that. Make sure you get your salary reduction forms into HR so you can take advantage of this extra savings coming in 2025. Now, for a lot of folks, charitable giving can be a great way to get a tax deduction. So before you even give to charity, we always say one of two things. The first, before you give money to charity, make sure you secure your own retirement first. We don't want to give to charity and then later down the road have to take it back, right? So that's number one. Number two, make sure that if you're going to give to charity, that you're first and foremost charitably inclined. And then secondarily, you'd like to get a tax break. Because at the end of the day, if you give away $1 to save 30 or 40 cents, at the end of the day, you still gave away 60 or 70 cents. So make sure you keep that in mind. Now, if you have a highly appreciated stock or a highly appreciated index fund, meaning they've grown quite substantially over the years, and you don't want to sell it, because if you sell it, you may have to pay capital gains tax rates at 15 or 20% at the federal level. You may have to pay state income tax, or even that pesky net investment income tax of 3.8%. Well, donating it directly to charity could be a way to get some nice tax deductions. So as opposed to selling that index fund or selling that stock position, let's say you have Apple from 20, 30 years ago, well, instead of paying the taxes up front and giving less to charity, well, you can give it directly to charity and you may be able to receive a nice tax deduction. So keep that in mind as you're giving at the end of the year.
Another way to potentially save on taxes before year end from a long-term perspective is to put your money into a Roth IRA. If you qualify to contribute directly, the limits are $7,000 if you're under age 50 and $8,000 if you're 50 or older. So again, that $1,000 contribution, catch-up contribution, similar to what the 401ks have. Now, there are income limits for contributions. You're all clear to put in that maximum amount, the $7,000 or $8,000, depending on your age, if modified AGI is below $230,000 if you're married filing jointly. There are phase outs between $230,000 and $240,000, which means you can't contribute the full amount, but you can put some away. And then if your modified adjusted gross income is above $240,000, again, married filing jointly, for single, it's actually $161,000, you wouldn't be able to directly contribute. However, even if you aren't eligible to contribute directly to a Roth, you can still take advantage of it through a technique called a Roth conversion. This is simply taking money from your pre-tax 401k or IRA and rolling it into a Roth IRA. There's no age restrictions or income restrictions, but you do have to pay taxes on the amount you decide to convert. This can be particularly valuable if you find yourself in a lower tax bracket than you usually find yourself. If you're, retired mid-year or you took time off, you might not want to let your low tax brackets go to waste. A large one-time conversion or smaller recurring conversion strategy could significantly lower your lifetime tax liability. Pro tip, take take the Roth conversion and also incorporate it with the charitable giving strategies that Greg was just talking about. That helps you to offset the taxes due that triggered from the Roth conversion. So be sure to work with your tax advisor on tax advice and your financial advisor to evaluate whether or not this tax optimization strategy is appropriate for you this year.
Those are some great tips, Allison, and keep those in mind definitely before year end. Make sure you act sooner than later. And until next time, we'll see you soon. Take care.